The Precious Metals Week in Review, June 19th, 2015. Brought to you by Precious Metals International. Volatility remained in all markets this week as analysts still seem to hang on every word and rumor out of Europe over the standoff between Greece and its international creditors. The U.S. Federal Open Market Committee, FOMC, monetary policy meeting, which concluded this week, also added to the market volatility midweek. The number of Americans filing initial claims for state unemployment assistance fell more than economists expected last week, dropping by 12,000 claims to a new seasonally adjusted level of 267,000. Claims for the previous week remained unrevised, and this marked the 15th straight week that claims held their ground under 300,000. The U.S. Federal Reserve seemed to be more upbeat over the status of the U.S. labor market at its news conference following the conclusion of this month's FOMC meeting. In a statement, the Fed said recent indicators suggest that underutilization of labor resources diminished somewhat. Previously, the Fed had described the underutilization of labor resources as little changed. Despite an apparent view that market conditions are improving, the Federal Reserve chose to leave interest rates unchanged and seemed to indicate that even a rate hike in September was only a possibility, not a near certainty, and remains solely dependent on data. As speculation continues to run rampant over when the Federal Reserve will choose to raise interest rates, inflation indicators in the U.S. seem, on the surface, to be climbing higher. In May, U.S. consumer prices rose 0.4% according to the Consumer Price Index, CPI, their largest such move in over 2 years. Much of the increase seems to have been driven by higher energy prices. Despite a resurgence in energy and the potential for higher food prices in the near future, particularly in poultry due to an outbreak of avian flu, the U.S. dollar continues to be strong against a basket of other currencies, and that seems to be keeping somewhat of a cap on consumer inflation. The core CPI reading, which strips out food and energy prices, jumped just 0.1% in May, the smallest increase in the core CPI since December. In China, the stock market dropped into correction territory as another 2% drop on Friday pushed stocks down more than 10% from their June highs. Analysts were quick to describe the correction as healthy and said that there is room for Chinese stocks to resume the rapid rise they experienced over the last year. Continued declines in stocks, however, might lead the People's Bank of China to take further easing measures, such as another interest rate cut or a reduction in the required reserve ratio for banks. On the positive front for China, the price of new homes, while still falling 5.7% year-on-year in May, actually rose by 0.2% from the previous month. It marks the first time that Chinese home prices have not seen overall back-to-back declines since April of 2014. If home prices remain stable next month, it may indicate that the Chinese property market has finally found a floor and may begin moving higher. Talks have continued to be at an impasse between Greece and its international creditors. The Finnish finance minister, Alexander Stubb, told CNBC on Thursday, "I think we've come pretty much to a dead end. We've been trying to find a solution for a long time. The ball has been firmly in the Greek court ever since the beginning, and I think it continues to be there." Athens has less than 2 weeks to make its payment to the International Monetary Fund, IMF, which now totals 1.6 billion euros, and almost no one thinks they will be able to make the payment at this point. Eurozone leaders have called an emergency summit on Monday to urgently discuss the situation of Greece at the highest political level, and it appears likely that those discussions will center on a Greek default and subsequent exit out of the euro. Greek savers, sensing how desperate the situation has become, pulled 2 billion euros out of the Greek banks in just 3 days, according to Reuters. The European Central Bank, ECB, reportedly told Eurozone finance ministers on Thursday that it was not certain that Greek banks would be able to open on Monday due to the pace of the cash outflows. Reuters, citing two anonymous officials, reported that the Eurogroup chairman asked ECB executive board member Benoît Coeur on Thursday if Greek banks would be able to open tomorrow. Coeur reportedly replied, "Tomorrow, yes. Monday, I don't know." On Friday, the ECB further raised its funding cap on emergency liquidity assistance to Greek banks by another 3.3 billion euros in an effort to combat the ongoing bank runs. Crude oil dipped into the upper $50 a barrel range this week as concerns over a Greek exit from the Eurozone mounted. Some analysts fear that the so-called Grexit could trigger contagion into other southern European countries, which could lessen oil demand. U.S. shale output also appears set to keep growing this year, despite the recent drop in oil prices, which continue to make shale production less profitable in the U.S. The euro dipped at the start of the week, but soon recovered ground and began trending higher. On Wednesday, the euro saw a spike higher, which continued through Thursday. Late Thursday saw a sell-off begin, but a recovery on Friday will see the euro close higher against the US dollar for the week. The Japanese yen moved mostly sideways for the week until Wednesday, when it saw a moderate sell-off. The dip was short-lived, and the yen had recovered its ground by Thursday and began climbing higher. The yen also saw a sell-off begin late on Thursday, but it too experienced a recovery on Friday that will see the yen close the week higher against the US dollar. Volatility should be expected to continue. Discussions between Greece and its creditors have reached a critical juncture, and it still appears that no solution is in sight. Charles Dallara, vice chairman of Partners Group and the man who led earlier negotiations between Greece and its creditors when he was managing director of the Institute for International Finance, told CNBC on Friday, "I am somewhat concerned that investors are looking at this and thinking the Germans, the IMF, the Greeks, they're all rational players at the end of the day, and we can all hope that they will be. But right now it looks to me as if the markets are not prepared for a default, and this could be a bloody bath if it happens." Seeming to prove Mr. Dallara's point, stock markets across the globe appeared to almost completely ignore the fact that the negotiations have broken down yet again, and that the likelihood of a Greek exit from the euro seems to be genuinely increasing by the day. In the US, it seems that each time the Federal Reserve chooses to delay hiking interest rates, the stock market goes off on another rally, buoyed up by the addiction to continued cheap money and completely ignoring global macroeconomic dangers. Most investors seem to be taking the same approach as CNBC's Jim Cramer, who said Friday on CNBC's Squawk on the Street program that a lot of people are waking up to the scenario that there could be a failure. If that's the case, there will be hedges all around, and it won't be as shocking. Mr. Cramer continued saying, "All I'm saying is that people are a lot more prepared for a default than they were 5 days ago." Based on Mr. Cramer's comments, Wall Street seems to be becoming even more highly insulated in its view on the world. The deciding factor in Europe's troubles won't be which supposedly savvy investor hedged the best. It will be the reaction of the everyday savers who fear losing access to the money that they hold in the bank. The Greek people will be the wild card in Wall Street's algorithms, and we firmly believe that there will indeed be contagion from a default by Greece on its debt at the end of the month. Other countries within the Eurozone remain under the same stifling austerity plans that were introduced as conditions of their own bailouts. If Greece is allowed to simply walk away from its own obligations in a default, the reaction of the population throughout the rest of Europe simply cannot be known. The next several weeks will likely prove pivotal to all markets as Greece enters what appears to be the endgame of its seemingly endless financial woes. Keep an eye and ear on the news over the weekend, and be prepared for any event which might send precious metals shooting skyward as previously complacent investors scramble to exit stock markets that might seem to become suddenly unstable. Wise investors continue to seek out buying opportunities to acquire physical precious metals in order to diversify their investment portfolios and decrease the risk of an overly heavy exposure to stock markets. Remember that precious metals should always be viewed as a long-term investment, and that the key to profitability through the ownership of physical precious metals is to actually acquire and own the physical products and to hold them for the long term. Always remember that you should never overextend your ability to maintain ownership of your precious metals over the long term. The Precious Metals Week in Review, June 19, 2015. Brought to you by Precious Metals International.